Hi, it's KeAmber Vaughn, aka Coach Key, and today's video will detail how credit card interest works. If you're watching this video on my YouTube channel, feel free to check the description box below for the blog post that is associated with this video. And if you're not watching this video on my YouTube channel, feel free to check out the link right here at the bottom of your screen for that blog post. That blog post is really important as it will go a little bit more into detail about the difference between installment debt and revolving debt, why revolving debt interest rates are so much higher, etc., etc. But for the purposes of keeping this video short, sweet, and to the point, I'm only going to show you exactly how credit card interest works. Now, credit cards and other forms of revolving debt are what we consider the bloody mess, simply because the interest rates and how interest is calculated on this revolving debt causes your pockets to bleed faster on the back side than you can put money on the front side. Credit card interest is literally the hidden secret to your revolving debt. And after I show you how to calculate not just the credit card interest that you will pay on your credit card, but also how you help the banks get rich, I promise you will look at revolving debt a lot different, and you will want to cut into their plan of how much money they already plan to make off of you from your revolving debt. So let's get started. Now, before we get into all the calculations and I start showing you how credit card interest really works, I want to first define for you what interest really is. Interest is the penalty you pay for the right to own something in advance that you cannot afford. Now, this definition seems to highlight a pretty harsh reality, but it's the truth. I mean, think about it. If you had the money to pay for whatever you're using your credit cards to pay for, you probably wouldn't be using your credit cards in the first place. In fact, most people use credit cards to make ends meet when their paychecks don't stretch as far as they need them to. And the problem with using and abusing credit cards in that manner is that you use this short-term method and end up hurting your pockets long-term due to the extremely high interest you pay on that credit card balance. Now, if you would like to have access to this form that I'm going over right now, head over to the blog post that's associated with this video and you will find this form to download and fill out for future use. Now, for example purposes, we're going to say that you owe $5,000 on your credit card. Now, you may owe more in credit card debt, you may owe less, but for the purposes of this video, we're going to say that you owe $5,000. And let's say that the minimum you have to pay on your credit card is $100 each month and you're just paying the minimum amount. And let's say that your credit card has an interest rate of 21%. So it's not only important for you to know and understand what your APR or your annual percentage rate is, it's also important for you to know what your monthly interest rate is. Now, for some credit card companies, they actually charge you interest on a daily basis instead of monthly, which means that even if you're someone who's trying to build your credit and you charge your card each month and pay it off every month, you're probably still paying interest because they may be calculating your interest based on the daily balance and not the monthly balance. So make sure that you check your credit card statement for that information. So we're going to divide the 21% APR by 12 because there's, of course, 12 months in a year, and that gives us a monthly interest rate of 1.75%. Now, to calculate your interest payment that you're paying every month, you're going to take the 1.75%, which equals 0.0175. You're going to multiply that by your $5,000 balance, and that leaves you with an interest payment every single month of $87.50. So now let's calculate what your principal payment is. We already stated that you're paying $100 a month towards your credit card debt, which means in order to calculate your principal payment, we have to take the $100 you're paying every month, subtract the $87.50 that you're paying in interest every month, and that leaves us with a principal payment every month of $12.50. So what's the reality of things? We're talking about all these different numbers, but what does it all mean? Here's your reality. You have a $5,000 balance, and if you divide that $5,000 by the $12.50 that you're putting towards the principal of that balance, that equals out to 400 months. 400 months. That means paying that minimum of $100 a month towards that credit card, you will end up taking 400 months to pay that credit card balance off. So what's your sentencing? Well, 400 months divided by 12 months in a year is 33 years. 33 years that it's going to take you to pay off that $5,000 balance if you continue to make the minimum payments of $100 per month. So how much does your bank earn? Well, $87.50 every single month is going towards interest. So if you take that $87.50 that you're paying towards interest every month times the 400 months of your reality, the bank will end up earning $35,000. And if you subtract the initial $5,000 loan, your bank profited $30,000. And the crazy thing is, the bank earns this money, right? So they've profited $30,000. They've now taken that money and they've lent it out to other people in the form of additional credit card loans, car loans, mortgages, personal loans. They earn even more interest on that, and they take that money and continue to exponentially grow their income and grow their assets and grow their money off of money that was never theirs to begin with. So as you can see, credit card debt and other forms of revolving debt literally keep you struggling financially. And the calculation that I just showed you, some people are doing this on more than one credit card. It's going to take more than you just paying the minimum balance for you to be able to pay this credit card off a lot quicker. Now, one of the best ways for you to start paying down your credit card debt a lot quicker is for you to take the credit card that has the highest interest rate and double or triple your payments on that credit card while you pay your other credit cards the minimum payment amount. As you pay that other card off, you want to take the amount that you were paying for that credit card and start snowballing it into your other credit cards until you've completely paid it off. Now, most people will say, hey, listen, I don't have any extra money to be able to set aside to start paying my credit card debt. I mean, this is the reason why I got into credit card debt in the first place. But if you have found this video useful,
well, guess what? I'm gonna give you all my secrets, okay? All right, because of that. The fact of the matter is, most people get stressed out when it comes to budgeting because it's very hard to stick to something so strict. I remember a little over 2 years.
Feel free to share this video with anyone you know who needs this information, and I will see you in the next video.